Dennis, the head of Global Emerging Markets Strategy at UBS, joins us on the phone line from the United States. Jeff, good evening to you. Thank you very much for staying up for us. Well, what's the sense? It's widely expected that the Fed will sound dovish, that June perhaps is out of the way. Do you think that there can be something in the statement that might leave the market a little bearish? What are you personally expecting?
I would be surprised. We expect the Fed to essentially repeat the message that they gave at the last meeting. In other words, pushing off into the future the risk of the chance of interest rate hikes. So I think given the way that the macro data has been coming in the U.S. over the last 6 weeks since the last Fed meeting, it would be a surprise if they turned more hawkish. And so we expect a pretty benign statement from the Fed tomorrow, frankly.
Okay, a benign statement from the Fed. Jeff, hi, morning. So having said that, how would you approach the emerging markets for the rest of the year? Because markets like India have seen a flat performance this year at best, while other markets like Hong Kong, etc., have gained about 15–16%. What's your own prognosis?
Well, we certainly think, having seen this tremendous run in emerging markets since the last Fed meeting six weeks ago, there's always going to be a vulnerability to bad news, and although we don't expect that negative news to come from the Fed tomorrow, obviously there is a growing possibility, or there is a chance that as you go through the year, the Fed may start to think about raising rates. Our own particular call is September. So I think we have to keep an eye out for what could happen in terms of U.S. monetary policy down the road, and the markets are, I think, vulnerable in EM to some strong data at some point over the next several weeks. Also, we've had a very good run, and valuations are getting a little stretched in emerging markets, and so we're waiting for earnings growth to come through also, which would be, obviously, would be beneficial. And at the same time, we've had such a huge move in China, obviously, particularly in the local market, the Asian market, that there's a vulnerability that you might get some sort of sell-off there. So I think there are risks out there, but frankly, we think these liquidity conditions that are in place now will remain in place for at least another couple of months or so, and therefore I think markets will continue to do well. So we feel that investors should still be fairly fully invested as far as emerging markets are concerned.
Okay. What about the kind of foreign investor selling that we have been seeing in India? In this month itself, about $1.5 billion has flowed out. It's not a great deal of money in the general scheme of things, but it has been consistent selling day after day, practically every day of April. Does anything happen to reverse that trend, or does it even plateau out?
I think it will settle down relatively soon. I think India's got a good story, and it's just had some significant profit taken, as you say, some significant outflows. And I think what's been happening here is that a couple of other markets, particularly China, but also, of course, Korea, have been attracting some money out of India. Most international investors appear to be overweight in India. Global emerging market investors have got a very big net overweight in India. So there was always the possibility that there will be a pause, and once you get some selling, it tends to cascade a little bit, and so everybody wants to take some money off the table. Obviously, there's been some disappointment in India over the earnings story in the last quarter. Some concern about the economy and will it pick up quickly with the reforms going through, and of course the recent decision on retrospective taxation of capital gains. So those are all represented challenges, good reasons to take some money off the table. But we think the Indian story is still very good, and we would be advising people to start to look to get back into the market before long now.
Okay, in fact, that was my final question, whether you would advise people to take money out of the table or get back into the market. So since you would advise Indian investors to start putting money into the market, what would your own assessment be of what the returns could be by the end of this year? I mean, it's been flat so far, but markets like China have already given 35% returns this year. In the India versus China story, what could the returns look like?
I don't think you were ever going to get 35% returns in India this year because the market was simply too expensive, I think, it had too much of a good run for that to occur. If you take a look at the the Hong Kong China Enterprise Index market, which of course is what best reflects what global investors invested in China. It's the best representation of MSCI China. That was very cheap, but it underperformed for a long time, so you're always going to get big moves there. And the local market in China has got some specific drivers which have pushed up valuations. But so you're never going to get those sorts of returns. But I would certainly be looking to add to India now, and then between now and year-end, we suspect there's a 10, maybe even 15% upside in the local market, because there's nothing going on with the story. The story in India is still very strong, with good earnings growth, with good ROEs, with the reforms coming through, with lower interest rates, etc. It's a good market. I think it's just a question of letting this sell-off run its course. And we'd certainly be looking to add to India in the very near term once again.
All right, Jeff, we'll leave it at that. Thank you very much for staying up for us. All right, so that is moderately positive. At least UBS will look to buy, but yes, India is facing some fairly serious emerging market challenges.